day, everyone. I am Jefferson T. Capuyan, and I will be your guide through this financial investment journey. So, before we even talk about the aspect of investment, let's identify what type of person you are. In investing, there are two types of person: a risk taker and a risk adverse. The type of person you are reflects on what you will invest upon. So a risk taker is a person who likes taking risk. If they are willing to take risk and gamble for bigger investments or opportunities to achieve their goal, while a risk averse person is someone who is shy away from risk. They avoid investment in opportunities that are far too risky. Now, have you got it? By identifying what type of person you are, you can identify what type of investment you would fall upon. Now, once you identify your what type of person you are, let's identify what investment fits you well. If this is a first step in investing, you need to have a steady information on what type of investment would fit you. There are three types. There is equity investment, income investments, and alternative to fixed income and equity investments. Or as a matter of fact, they are called alternative investments. Now, the equity investment, one of the most common equity investment is stocks, where stock investments are a way to get an ownership in a corporation, so being like a shareholder. It represents a claim on the part of the corporation's asset and earning. So as long as the corporation gets an earning, you get a part of that. It has an unlimited upside. You can get a huge income from stocks. It is one way to increase your value of an asset depending on the stocks market. Although the downside of this is very risky. In a matter of fact, in one day, if the stock market suddenly drops, you, the value of your asset could drop to a 50%, which is very risky, and you should think about identifying and being in a stock investment. Next is fixed income. Bank deposits and bonds are a type of fixed income investments. Bank deposits, based on its name alone, it's about putting your money or putting an investment in a bank for safekeeping. By the use of the interest rate of the bank, the, your money grows and it has a possibility of settlement risk where if the bank closes, the only money you will get is for the settlement. Next is it has a low interest rate payment. Besides the fact that it has a low interest payment, you will already know what is your known income based on your outstanding capital and current interest rate. The banks always present a data or a matter of fact a table in which how much money you would get depending on how much investment you would put. A bonds investment is like an IOU. I owe you something or I owe a person something. So it's a fixed income instrument that represents a loan made by an investor to a borrower. It's typically a corporate or governmental because they always issue bonds. You can't lose some money in bond as long as it is held until maturity. Past maturity, this is where everything gets bad. You can be subjected to interest risk, some settlement risk, and such. Now, the two alternative investments that we will talk about is the mutual funds and the UITF, or the unit investment trust fund. So first of all, the mutual funds is a financial vehicle. It's almost like a stock, but your money is being handled by a money manager. This can be advantageous because typically money managers know how to use money effectively, how to ensure that you get the best out of it. Although there are fees such as management fees because you are paying someone to handle your finance. A similar investment to mutual funds is a UITF or the Unit Investment Trust Fund. It is handled by the bank, so unlike mutual funds where it is handled by money managers, UITF is handled by banks, where it has more advantageous because it is accessible to any clients as long as there is a branch of a bank nearby and it offers UITF. This ownership does not guarantee shareholders' rights. That doesn't mean if you have an investment in there, you can decide what will be your dividend, what will be your voting. This means that you only have the money placed in there to mature, not to handle the company itself. Now, choosing the right place to invest is very important. You can gain interest income if you know what to use, and what is the right investment for you. You can effectively use it to gain interest income, which is the main reason you are investing. You don't want to lose your money. Although there are a couple of risks in investments, like I've said, all investments has a risk. It depends on what type of person you are and what type of investment you are willing to forego. This is why it is important to research and identify what is the best investment fit to your personality. Either you're a risk averse, or a risk taker. Now, an study, uh, additional pointers is investing control. It is important to identify and to control what you are investing. One tip in investing is having a diverse portfolio. What do I mean by a diverse portfolio? Instead of putting all your investment in one type of investment, why not diversifying it? Like 25% in stocks, 25% in bonds, 25% in bank deposit, and so on and so forth. This way, if the stock investment falls through, you still have backup. You have plan A, plan B, plan C, and plan D. Do this, you can effectively earn interest income in all your investment and minimizing the risk of losing all the money you invest. So, I have a last statement for you. Invest logically. Be logical. Think what is appropriate. Think what is right. Think what fits you and think what type of investment is personally for me is correct. What is the most safest, what is the most riskiest, but you should matter what is right in your eyes. And this is where our journey ends. That is all. Again, I am Kurt Jefferson T. Kapuyan, and it has been a lovely being your guide in this journey.